Since you are here viewing this presentation, you're probably asking yourself, what exactly is data trading? Well, very simply, data trading is the trading of different markets, such as currency markets, index markets, whatever the case, based upon economic data the moment that data is released. The economic data we would normally look at would be things such as employment numbers, gross domestic product, consumer confidence, interest rates, whatever the case may be. When economic data is released, it's done so at a very precise moment. In the build-up to that moment, the markets will start to move in the direction of the expected or forecast data. A quick example is this chart of the Japanese yen moving down in anticipation of positive US data. Positive data for the US dollar normally has a downward effect on the Japanese yen. Then, when the actual data is released, there can be a sudden spike in the markets caused by the deviation between the forecast data and the actual data. And that causes what you see here. Again, the Japanese yen had been moving in a downward fashion in anticipation of positive US data. However, the data in this case ended up actually being negative. After that negative data was released, we see a sharp uptick in the Japanese yen. So before we go any further, why don't we clearly define the word deviation? All data trades are taken based upon the deviation, and it is very simply the difference between the forecast data and the actual data. In the days leading up to each economic release, numerous economic professionals are surveyed to get a consensus of what the data should be when it's released. This is the forecast data. Then on the day the actual data is released, numerous news services gather in a room and are given the real numbers. They release this information at an exact time. What you see in this example is a small section of an economic calendar. You see here that there is a column for the forecast data and also a column for the actual data. Look here at the row called ADP, Non-Farm Employment Change. You see here that the forecast was 40,000, but the actual data came in at minus 23,000. So, doing some quick math, what this means is that we had a deviation of minus 63,000. So what does that deviation do to the Japanese yen? Well, we're going to see. Again, going back to that same chart, the market is moving from 10742 down to 10, around 709, right before the news comes out. What you're looking at here is now video of that same chart as this information is set to be released. You'll also see an actual trade that I took based upon that data. Again, the market is moving down, the Japanese yen. Why? Because they're anticipating positive US data. So, if the news ends up coming out negative for the US data, which it does, as we already know, that will cause a spike upwards in the Japanese yen. And you'll see that in just a few seconds here. And there you have it. What you see is as soon as that information is released, the market spikes up. My program is designed to take a trade, which it does at around 7:30, and it exits that trade at around 7:40. So how does this work? How do we take advantage of these spikes that happen in the markets when this information is released? Well, my system has a predetermined deviation that I plug in. When the actual data is released, my system quickly interprets the data, and if the predetermined deviation requirement is met, it places an order. And as you see in this example, the system caused a short order on the British pound that was filled at 1.5364, and then I had an exit order that was filled at 1.5354. I can also set up this system to attempt to get me out at a larger number of ticks if a second higher deviation is met. In this chart you'll see that I actually took 20 ticks instead of 10. This is the UK retail sales month to month that took place on March 25th, and because it was a fairly large deviation, again I set it for 20 ticks, so I got in just under 49.75 and got out right around 49.95. You have to understand that there is an art to data trading. You have to select the correct economic events, you have to select the correct deviations, you have to understand how to manage the trade, and you have to understand what technology is necessary. I work with a team of traders who have many years of experience. We trade what we know to be high impact economic news events. And experience teaches us which of these events creates the best opportunity. Experience also teaches us what minimum deviations we need to create a move large enough to be advantageous to us. And of course, experience teaches us how to manage these incredibly quick trades. Here's a chart that shows me trying to take more than the trade was willing to give. I tried to take 20 ticks, and the trade only wanted to give me 10. And the last piece in the art of data trading is the technology. You need a data feed. You need to get this information as it's coming very, very, very quickly. You need that information to then translate into an automatic order. You need that platform that you're placing the order on to be as fast as possible, and you need the order to reach the markets as quickly as possible. All of these things need to work together to get your order to the market as fast as possible. You also need to get out of that trade as quickly as possible. The advantage of using my system is that it gives you all of this: the experience in selecting the news events, the experience in what deviations to use, the experience of trade management, and some of the best technology.